Today's episode is brought to you by Mazars. SoundCartel. When you hear that the share market is at an all-time high, is that the time to sell or buy? Is it a good thing, a sign that we're heading for a correction, or something worse? From SoundCartel, I'm Nicole Goodman, and this is Business Essentials Daily. It's tempting for the media to dramatise market fluctuations, and all-time highs can often say more about the commentator or the emotional investor than what's happening in reality. Keady of APW Partners brings us back down to earth and advises whether there's any need for concern as an investor. First, Chris Ashmore asks Greg, what exactly does it mean when the market is at an all-time high?
Chris, when the market is at an all-time high, it means, quite simply, it has never been at that point in time before. That's a pretty obvious statement. But it means, insofar as the market is concerned, the aggregate of the companies that make up the market, on average, are at an all-time high. So in the case of an index is an amalgam of whether it's 100 or 200 or 500 or 1,000 companies, but it is heavily influenced by the largest of those companies. So the All Ordinaries Index, for example, 80% of the entire market resides in the top 20 companies. So the top 10 companies might account for something in the order of 40%, for example, of the market. So it's very influenced by the position of the largest companies within the market. So it's not the case that every single company is at its all-time high, but the market weighted by the largest companies is at an all-time high. And that's not always representative of how investors have chosen to invest. That is certainly the case in Australia. The index itself is a market capitalised weighted index. In other words, the largest companies explain the majority of the return. In some countries, markets like the Dow Jones, for instance, that particular index is actually price weighted. So it's actually just literally adding up the price of those 30 securities and weighting them according to the level of their price, not so much the value of the company. So it can be a little bit misleading. It's not intended to be misleading, but it really is a matter of understanding what that question implies. I think generally people understand it essentially as that the aggregate of companies have actually reached a point in time that they've not necessarily been at before. So that is certainly the case as we speak with the Australian share market, sitting at a level that we've not really seen. It's only marginally, it's not significantly above its previous all-time high of February last year. It's about 8% above that point. But if we looked at its low in the recent period, back at 23rd of March last year, it's about 71% above that particular previous low. So market highs essentially, I guess, carry different meanings.
What happens historically in periods when the market does post an all-time high?
Yeah, so if we look back through each of them, and I guess it depends over what period of time that you're looking at, there are extreme examples, I guess, if you were to take a view that leading up to the Great Depression that the market was an all-time high, it took, in excess of 13 years for the market to actually break even. If we look at Japan and go back into the late 80s, we can see today that previous peak essentially is still yet to be achieved, 30-odd years later, is quite extraordinary. So different countries and different eras result in, I guess, in particularly extreme circumstances, very different scenarios. But if we hold for those extreme experiences, essentially look on average, markets tend to actually continue to be positive, typically, in the 1, 3 and 5 year periods after an all-time high. I guess if we were to look at an example, for instance, of the last 30 years, we went back into the late 80s and looked at the largest market globally, the US share market, and looked at what happened in periods after, I guess, the different all-time highs. Just to put that in context, the all-time highs in this calendar year alone, we've had 48 individual all-time highs. Seems like an extraordinarily high number when you think about it, because it's not commonplace to sort of contemplate that fact, but over the course of the last 10 years, last year we had 32, the previous 35, 2018 there was 18, 2017 there was over 60 all-time highs. So it's not uncommon to actually have all-time highs. And I guess if you're a company and you're growing your earnings and you're growing your profitability year on year, and that's your objective, it's reasonable that the prices will actually increase over time. It's a bit like property. Every rolling 5 or 7 year period, you'd expect a property to be higher than where it was at the previous point. Typically after all-time highs, over the course of the last 30 years, markets have tended to continue to post double-digit returns after all-time highs. But it really depends, I guess, as to literally how the market achieved an all-time high. In this particular recent period, we've seen markets grow at such an accelerated rate that they've achieved their all-time high really, really quickly, or particularly off that low base. So, there's no guarantee that an all-time high will translate to an all-time low or a continued all-time high, but more often than not, markets are positive rather than negative after attaining an all-time high.
What can you say about those periods, Greg, when the markets have grown by, say, more than 50% over 12 to 18 months?
Yeah, so they're periods, I guess, that are less typical. And they're periods that people should be probably more wary of in terms of, that really accelerated short-term growth. When I say wary of, just being aware of setting expectations. Just because markets have actually grown by 50%, particularly for new investors that started investing in March last year, that are unaware of historical returns, would probably be a little bit distorted in their perception of reality, thinking that markets grow 70% in a 12 or 18-month period. That's a highly unlikely, a highly unusual event. The US share market's up over 100% over that same period, and most global developed markets are well up over 50% in that period. So if we go back over a long period of time, back to say 1950, and look at events like a 50% gain, we don't tend to find that markets continue to grow at that level in a 12-month period. On average, in the US alone, if you looked at the last 70 years, when the markets went up by 50%, they posted a slightly negative return on average in a 12-month period, but achieved very positive double-digit returns in the 3 and 5 years after the previous peak of a 50% growth or above. So, markets are more often positive than negative. 3 out of every 4 years, 75% of the time, markets are positive. But they can have sustained periods of negative returns, and that's really, I guess, a question of then how much of a portfolio should be allocated to shares to be able to tolerate that uncertainty that does accompany the particular asset class.
Should I be concerned as an investor?
If your time horizon, Chris, is relatively short term, there's probably good reasons to be concerned no matter where you are in the investment cycle if you're investing heavily into shares. So if your investment portfolio is primarily exposed to companies, whether that be in Australia or overseas, genuinely your time frame for investing should be 10 years. Okay, now there might be products and investments that talk about time horizons being less than that and so forth, but genuinely investors should actually be considering a 10-year cycle for investing. If it's a lesser period of time because I need that money to buy a car or put towards a deposit on a house, and if it's in a relatively shorter time frame, sort of the next 2, 3, 4 years, investors really should seriously consider whether they're willing to actually accept a 15 or 20 or a 30% decline, a rapid decline in a short space of time. That can happen. Will it happen? No one knows. If we knew the answer to that question, there would be no uncertainty about the future. There would be no volatility as such. So I think it is entirely appropriate for investors that have actually ridden the wave. I guess there's significant rise in markets over the course of the last 12 or so months. If they have a short-term commitment and need that money, they should seriously think about making sure that they have what they need when they need it, and accept that holding shares could easily see that fall in value.
Well, going back to the crux of this interview, Greg, I suppose when the media says things like the share market is teetering on an all-time high, it's really words like that we need to think about as investors and not be sucked in, I suppose, to what the media is trying to get at.
Yeah, I think if you're trying to get someone's attention, you make a little bit more noise, or you might exaggerate or behave in a manner to get the attention, and I think sometimes the media can be guilty of that. But the inference essentially is that, something's about to happen. Be mindful, be careful, be wary. That appeals to, I guess, the fear and greed that all of us actually have. And I guess you've just got to be able to keep that fear and greed in check and ensure that you've got a prudent time frame, ensure that you're not overly concentrated, that you've got diversification, that you've got the ability to withstand, a decline in value or less earnings coming from dividends and so forth, and you've got a backup plan, I guess, in the event of that you do need access monies. You don't want to be selling your assets when they're actually falling in value. But there's not a lot of evidence that actually suggests that you should sell just because the market's at an all-time high. I think that's the message that people need to understand.
That was APW Partners Executive Director and Principal Advisor, Greg Keady. This episode of Business Essentials Daily is produced by the team at SoundCartel. Thanks for listening. I'm Nicole Goodman. We'll bring you more Be Daily tomorrow. Follow at BE Daily Podcast across social media and head to bedaily.com.au for more from the Business Essentials Daily podcast. SoundCartel. This episode was brought to you by Mazars. To find out more, visit mazars.com.au. That's mazars.com.au.